Hello, everyone, and welcome. My name is Corey Thornton. I am the Managing Editor for Market Intelligence at Open Minds. Today, as part of our weekly Executive Web Forum series, Open Minds Senior Associate Ray Wolf will discuss the Open Minds approach to nonprofit financial strength assessment. Mr. Wolf has over 40 years of experience, including expertise in managed care, value-based reimbursement models, financial analysis, and strategic planning. Before we get started, we have a couple of housekeeping reminders. Your audio will be muted during today's briefing. We also rely on your questions and comments via the question box on the right side of your screen. You can send in your questions throughout the briefing and Mr. Wolf will answer them. The slides and recording for today's briefing will be available on the Open Minds website starting tomorrow. And with that, Ray Wolf.
Thank you, Corey. Today's discussion may tend, I think, to be a little geeky as we move through the dashboard, but the essence of it is that it's important for us to build knowledge into our systems, and that financial knowledge can be portrayed in ways that we have not seen that are critically important for us as we move through what is one of the most difficult times we've ever seen. As I break down this presentation, I'm kind of thinking of it in three parts. First, just giving a quick overview of why I think budgeting no longer satisfies the kind of needs that we're going to have, and I desperately do not want to use the word new normal, but let's say new era. But that financial performance management as kind of a phraseology likely does, and what kind of changes will be required to get us there. The biggest portion of the presentation, I want to talk about the effectiveness of the dashboard that we are using at Open Minds and how it monitors progress on a yearly basis and shows us some major trends about the way organizations financially have come to be in the situations that they are. The final piece of that, I think, is critically important, and I need to give kudos in that to Bob Kreider from Devereaux, who helped contribute to that analysis. Bob originally worked at a firm that did bond analysis and market ratings, and as such, we've developed a little methodology to kind of rank yourself against others. Finally, let's assume that we decide that our organizations need this kind of progress. What do we need to do to bring it into a place? What are the key steps? How will it look different? Most importantly, I think, how will it culturally be different? And how will it change us in the ways we manage in ways that I believe probably are more beneficial for what could be a wild west of new kind of payment options and methodologies and extremely difficult margin analysis of what we do. So let's start with the problems of budgeting and performance management. And I wanted to start with a series of questions because the traditional budget is an income statement budget, and it shows how much money you've earned in the year and how much money you've spent and what the difference is. And largely that's the focus of 90% of budgeting and 90% of our reporting. But it doesn't answer the kind of everyday organic questions that we see as we try to financially manage our organizations. I've listed some of them here, and let me give you examples. Simply knowing the bottom line will not tell us whether we can afford a new program. It won't tell us what kind of impacts that program will have on the company if, for example, we have to put expenses in for 3 months before we start generating revenue. Or on the other end of that, if we have to wait 60 to 90 days to have that revenue returned. Can we afford that with this program or can we not? We don't have the tools in a standard organizational budget to answer that question. Nor do we know the answer to whether or not purchasing a facility or leasing it is the correct answer. How will it affect how we appear, how our books are managed? What is the appropriate answer for that question as we approach growth or other impacts along the lines of major expenses or major asset purchases. Mergers are happening at a much higher rate because people are seeing very, very clearly now that going it alone may not be the best transition. But we need to be more cautious about the partners we take. In that kind of environment, how do we know what the impact of the partner will be to something more than our bottom line? How will it stress us in terms of our ability to mortgage or our ability to generate profits on a regular basis? What kind of impacts can we expect to have on changes in administration when that occurs? These questions, as they come up, again, are not answered by a budget. Let me run through the rest rather quickly. Extensions of line of credits, which are becoming more and more difficult. We'll have the bank looking at data that we traditionally do not look at. We need to, in those situations, to be very clear about what to expect in that process as we move in. An EHR may cost $150,000 up front, be absolutely essential to our long-term survival. Can we afford that? Can we afford it differently if we were to move ahead? In what programs can we take rate cuts and in which can we not? Value-based contracts in this day and age often require rate reduction in exchange for an incentive opportunity. They are a trade-off. So how much can you afford to cut and still manage through the course of the year? Finally, the most important question that all of us ask and none of us really seem to have a good grip on is, when compared to others, what are my chances for long-term survivability? If the effort and time that we put into budgeting does not provide answers to these questions, then what we're doing needs to be modified. And it needs to be modified in ways that not only answer those questions, but answer those questions real time, so that we will be able to look at an internal system that has some mechanisms for self-correction, that can address present weaknesses and know where weaknesses exist and move those before the time comes that they become problematic, that monitors the position of each individual department, monitors cash position, monitors the project status of major events or initiatives, and can self-correct when those things become wrong. Budgeting systems traditionally in our environment do not do that real time. What they do is 45 days after an event or in a board meeting allows us to explain what happened, but not to have leading indicators to tell us what we expect will happen. So we need a financial performance system that looks an awful lot like our clinical performance system. As many of us have moved into the standardized measures and have begun to develop good quality departments that are operating on lean models or Six Sigma and addressing problems and workflow issues, we have developed a significant amount of new knowledge about how we can improve performance and improve outcomes. In that regard, financial performance should be much the same. And as we roll this out to the organization, the general steps that we put in place need to be followed in this financial model as well, including leading by example, including democratizing data and making sure that everyone can see and understand the metrics that we've decided are important and how we're doing. People need not only to see the graphs and metrics, but understand what the underlying value of that metric is and why it's important to monitor. They need to see it in the format of a standardized dashboard. They need to follow through with managerial action when those dashboards are negative, and to become more disciplined in that process. And finally, I think it's essential in any kind of new training or implementation to celebrate. And none of that is new. All of that is something that we've learned as we've developed and implemented clinical quality performance systems. And now they apply particularly to management systems, to financial management systems. So where I want to go now, just giving that brief introduction, is a quick discussion, and not a quick discussion, but a lengthy discussion of what a dashboard might look like and what are some of the indicators that you ought to include and why they might be important. But before that, let me stop and ask Corey, are there any specific questions at this point that we should be responding to?
Absolutely. Thanks, Ray. We have it's a two-part question. First part is, how much will building a performance management system cost me in purchases and staff time? The second half of that question is, how can I find the time with the present staff to implement a different process?
Well, the good news is that the cost may be minimal. For some people, I would say that your budgeting tool will probably need replaced, but budgeting software, like other good softwares, has become much more inexpensive over time. And we're not talking about an entire finance system. We're talking about perhaps a forecasting tool, many of which are available online and require no real installation. They can upload and download data in Excel and other SQL formats. So the ability that most of you will have to communicate with it will be minor. And frankly, it won't be one of the first things that I think you should buy. It probably is something that would happen after you've developed the systems you want, after you've seen how this might flow. The question about staff time is more difficult to answer. It likely at the end will mean a finance department that is probably no different in size or total FTEs than it was beforehand, but it may require different skill sets than what you have. So in that regard, you need to be looking for people who can do different efforts. And I think in terms of when we get to implementation, I want to take a few moments and kind of look at where we are in that process as we move ahead and talk about maybe some of the different skill sets that would be needed for adding a position, a budget manager, a performance manager position. What are the skills that might be needed for that? Are there other questions, Corey?
That takes care of it, Ray. Thank you.
Thank you. So the next question is, how do you display information in a way that makes sense? And that brings us to this issue of the dashboard. One of the things that I wanted to do from almost the very beginning of my time at Open Minds was to begin and to build a financial dashboard that would have two characteristics. One, that it would give me some quick information with respect to the client so I knew what to recommend appropriately. And when I was, whether it be in discussion of a compliance project or a strategic plan or a merger activity, to let them know what their various strengths and weaknesses were and what to expect. So I needed to get something that I could very quickly use to implement that would make sense for an organization. I ended up developing a tool that I think meets the key criteria that I've kind of established. First, that it's quick and easy to use. It runs off a single Excel spreadsheet and therefore is logical in many of the ways it flows, and that is reused. So largely, with about a half hour of input time, I can generate an enormous amount of information. Secondly, I wanted it to show a long-term, in terms of the characteristics, I wanted to show a fairly long-term view. I wanted the graphics to be very clear and detailed in the way that they were organized. I wanted that organization to be by theme, so it was easy to explain. And I wanted to be able to input into those graphics expectation points built on the industry. I've been using this tool now for about 8, 9, 10 months. And over the course of that time, I've probably done this work on 25, 30, 40 organizations. So I'm beginning to see some trends. We have yet to reach a place where we have enough data that I can begin to tell you what industry benchmarks are or what they are for any given moment. But I think that's the next step and where we might be heading with a project and a white paper as we move ahead. But let me kind of give you an overview of the dashboard and begin to move into the details. First off, when I look at finances, I think that there are 6 key factors that contribute to what I would call long-term sustainability. That long-term sustainability has its own metric. So it's really 7 domains that we manage. But the truth is all of them contribute in different ways and all of them affect the outcome. You want to know basically how liquid you are. Are your cash reserves sufficient? We've spent a lot of time looking at that structure, and over the course of the last year as cash has become such a great issue in terms of process. The other side of cash is leverage. Have we mortgaged too much or not enough? How do we meet standard in that regard? Is there a cushion for us if we would run into issues that would require major construction or other projects of a more long-term and a more expensive nature? How's operating performance? Not just in terms of bottom line, but bottom line when compared to metrics that allow us to look at ourselves when compared to others. Are we efficient in our administration and in the processes that the administration might portray? Have we reached a level where we are rolling cash through at an appropriate level and managing expenses and expense payments appropriately as well? Those kinds of metrics can be measured and graphed pretty effectively. More and more as we enter into value-based contracts, the issue of risk tolerance becomes key. Risk tolerance to me is what can I afford to put on the table to risk going forward? This is a concept which many financial managers today are completely in the dark about because most of them have lived in environments where they don't feel that they have any wiggle room to meet budget standards as they exist. Yet to move into the next phase of value-based reimbursement, we're going to have to be able to show some kind of offset, some kind of reductions or potential reductions to fee-for-service rates in order to have the size of the incentive going forward. And we need to be able to know what's on the table for us and how might we approach that discussion. So the dashboard contains all 7 of these. I'd like to walk you through it and let you see in detail what's in there and how it has developed in ways that now allow us to see and talk about each of these characteristics. Just to be on the same page, I want to start with each topic by defining it pretty completely as we see it. Liquidity is the ability of a company to pay off its present bills and to do so in a way that as long-term liabilities become current, they can be paid as well. To do so in a way in which there's a cushion. How do we measure that? I've chosen a couple graphics that I think are important in this regard. Let me show you what I think. First, working capital. Working capital is an excess amount of cash available after all the bills are paid. This is the amount that we would have to spare if we were dealing with negative events or planning some major growth initiative. This factor will change over time, and it tells us a lot about our company when we see the graphic over a 4 to 5 year period. In this situation, using this example, this organization has gone through a major shift between 2018 and 2019 and is today working with substantially less working capital, is working tighter and closer to a cash zero than they have ever before. As we look at this, we can see that some problems or issues began to occur well before the pandemic, and that what we need to look at about addressing the actual reasons for this lies in events and occurrences that occurred at some time in the past. In addition to working capital, we need to look at our current ratio. Current ratios are the proportional relationship of debts to assets. So if I were to say I have a current ratio of 2, that means that my cash amount is twice the amount of my bills. 2 is a good indicator. 2 is a place that a lot of people in the commercial business want to be. No one in our industry, I don't think, is really sure at this time in terms of benchmarks, whether we are at 1.5 or 1.6, or whether the 2.0 average should balance for us as well. But as we get more data about how organizations are working, we can begin to see how this ratio manages for us, and we can begin to put in benchmark items. Each of these tools, be they the working capital or the current ratio or the next one in terms of days in cash, these ratios will tell us a lot about what's wrong with the company symptomatically. I think you should consider them as diagnostic tests as we move forward and look through these processes in a way that can yield a result that's helps us look at the organics of the company and make key decisions about the way operations occur. Days in cash is an interesting indicator as well. Days in cash usually involve 2 different kinds of cash. One is the standard checkbook, what we have available, and the second is what we have in unrestricted investment. Days in cash is defined as how long could I go paying bills at the same pace that I'm presently paying them if I had $0 coming in the door? When would my bank accounts and investments reach 0? So if you look at this and you look at a 2020 number of 22, you would say that at the end of about 22 days, on the average, I would run out of cash in the checkbook and have to move into my investments. Once I moved into my investments, I would only have an additional 17 days before I hit an absolute 0. Now, I know that that's 39 days, and during that time, other cash would be coming in, but it's a good way to give yourself a sense of how these ratios play out in terms of how you would measure against others. Assume the state goes through a period of time where they're not paying appropriately, or a managed care entity is having a computer conversion. This gives you a sense of how you might match up against others in that regard. It also, because of the way the graphic is laid out, gives you an idea of how your unrestricted investments are when compared to cash. And maybe you want to set some standards there about having an investment portfolio that's a little larger. The more cash you have on hand, the more likely you're going to want to invest it in places that yield bigger returns. So as that blue segment grows, the ideas that your finance committee and your CFO might have about how to shift some money into investments will make some sense. These 3 together tell us issues about liquidity. And just like in this version, we saw the current ratio going down, we saw working capital going down, but for some reason we saw days in cash going up. They provide us some indicators of what may be happening, and they provide us with some questions that we may need to ask as we move forward. One of the reasons that you may have cash days going up, but current ratios going down is that current ratios consider not only the cash you have in hand, but they consider your accounts receivable, those things that you've billed. Maybe you're doing just a better job of collecting on your accounts receivable, so a little more is available in cash than might have been previously. These are all items that I think that the diagnostics of liquidity would allow you to look at if these graphs were available in your entity. The second thing I would want to look at is operating performance. What are the short-term trends that generate financial reserves, and how are they working for you? A good dashboard will probably focus pretty heavily in this area because everything we see in the balance sheet, from the receivables to the quality of our assets, the amount of our debts, the impact on our cash, really flow as trailing indicators to what happens on a monthly basis or a regular basis in terms of our financial solvency and our operating margins. If you haven't been, it's critically important that you start to consider your operating margins as a percentage of the expenses that generated them. This allows organizations of very different size to compare themselves to each other. 2% operating margin for a large company may be substantially different than a 2% operating margin for one that is smaller. But the trends in that regard are just as critical to both. And the ability to measure yourself around industry metrics are extremely important. There's a lot of disagreement right now in the field about what a good operating margin should be. Some people are saying 5% and 4%. For me, I prefer a smaller number, but absolutely carried out over a long period of time, no variance. If you're talking about the 2% margin that I've mentioned to some of my clients, what I'm saying is 2% every year. And if in fact you're going to miss a year, you should do everything you can to address that before the year is done. So if you do not have the ability to manage mid-year or to make rapid corrections, you need to be budgeting for more than 2% to account for those problems. In this organization, what we're seeing is that substantial negative impacts have occurred, but that they have begun in 2020 to address them and to move in a positive direction. This is an example of a place I would begin to set break-even and positive goals as we move ahead with that company. Administrative costs is an interesting area to look at. There's kind of a rule or standard that organizations of a certain size likely need to be operating at the lowest administrative cost possible. And that's for a very basic reason about how our markets work. The truth of the matter is that when we hire direct care staff or managers and supervisors, or when we spend money on facilities and supply costs, largely everybody else producing that service has to spend roughly the same amount. There aren't big differences when it comes down to looking at the big overall picture. There aren't really big differences in staff salaries between organizations or the percentage of money that's spent in salaries and benefits. There aren't really large differences in facility costs because we all have the same utility companies and we all are, if we're competitive, competing in the same marketplace and showing those results. So when rates are cut, it's going to be very difficult to look at ways, given our regulatory environment, given the competitive and operational environments that we live, it's kind of tough to think about how you might cut program costs. So managerial costs and administrative costs become the only place. Therefore, a company that's operating at 10% margin is able to be putting 90% of their costs into actual care for the person at the community level, is so much better off in terms of dealing with these issues. What we know is there's a very, very strong correlation between the percent you spend in administrative costs and the size of your company. The larger the company in any given environment, and it will change state to state because of regulatory issues, but the size of the company has the biggest impact on the percentage you spend. The easiest way, therefore, to reduce that expenditure is to use an administrative cost benchmark and to try to aim yourself at that 10% margin. This becomes critically important when you talk mergers and acquisitions as well, because if you're looking at a smaller company, or if you are a smaller company looking to become part of a bigger network, the cost savings that you might get in that process will largely be the difference between the administrative cost at one level that existed prior to this effort and the administrative costs at the 10% mark. Quick rule of thumb. You've got a 12% ratio here of administrative costs. You'd like to get that to 10. That means 2% of expenses can largely be saved. If a company is $100 million in size, 2% of expenses is $2 million. That tells you in the course of this merger what your target would be and how that 2 million would affect profitability, and you can begin to see the impact of that organization on your bottom line going forward. Much more analysis than that would need to be done, but a darn good rule of thumb, quick hand way to get that done and to begin to see right off the face of it whether an individual company may or may not be working in that regard. It's also a good tool for boards to be able to say to your board that your administrative costs are at this level and industry standards are here for organizations of 100 million or over. One of the things I hope I would get with a potential outreach to all of you is to determine how the benchmark norms change as we look at organizations of different size. What is it, for example, for a $50 million company? What is the standard for a $10 million company? And where are we at 100 and over? Those will be interesting benchmarks that can help us use this tool going forward as we become more effective and become more involved in a merger market. Leverage. Leverage terminology is not one that we're accustomed to, but it matters a great deal in the work we do. Leverage is the long-term commitments and how we pay them off. Have we over-mortgaged? Have we under-mortgaged? What are the norms that we should be looking at? In general, this is a balance sheet issue, not an income statement issue. When we look at leverage, what I would be interested to see is how many assets do we have when compared to our liabilities? If we had to liquidate, for example, would the assets have the capability of paying off all of the liabilities? What's a good metric in that regard? Generally, for commercial businesses, they would say if your assets to liabilities ratio is less than 2.0, you shouldn't be considering any kind of mortgaging. You should also be considering refinancing and regrouping to create less liability, or selling off some assets in order to attain that kind of liquidity that would move you ahead. But in general, this gives you an idea of your big time capability to address a huge impact. More than just cash, if you have the ability to borrow, you can react to major long-term trends. You can react to huge events, such as the loss of a major building or things like that. and be able to respond in ways that keep you afloat. So knowing that you are above your metric here would be critically important in that regard. The second way to look at it, a little more telling, is your debt to equity. There are basically three elements of a balance sheet: what you owe, which is debt; what you own, which is assets; and the difference between the two, which is equity. Equity should always be a positive number because the amount that you have in assets should always be more than the amount that you owe on them. But how does that debt compare to equity? In general, we like to see debt to equity at numbers of 1 or smaller. Debt to equity is a key consideration for banks in lending, and your debt to equity number would be something that you would want to deal with them and show them if you were negotiating a further loan or negotiating a continuation of your line of credit. Looking to keep this under 1 becomes key and provides you some sense of when I can borrow and when I can't borrow, when I need to adjust operating performance upward, and when I'm fine with the status that I've met. Process efficiency tells you a lot about your administrative departments. And in this regard, I like to look at 2 of them on a single graphic. And this is basically cash in, cash out. For those of you who are having cash issues, this is something that you would want to see not only on a yearly basis, but potentially monthly as well. Days in receivable, the amount of receivables that you have compared to the amount of time that it takes to collect that receivable. So if you're billing $1 million a day, $35 million of unpaid bills would mean that you're roughly collecting on bills about 35 days after you record them in your system. I think this ratio varies a lot by environments. Those more dependent on government may find these ratios higher or lower. Those more dependent on managed care companies want to monitor this by payer so that they can see effectively who is slow to them and why. That second line, what you compare it to, is interesting as well, because that's the speed that you're paying bills. Perhaps that speed is too quick. I think things in the 20s are appropriate, but I've seen a lot of folks in our industry that are paying in the teens, and 17s, 16s, 15s. Why is that? When I've asked that question, what I've discovered is it's easier in a finance department with minimal staff to just pay bills as they come in and to get them out the door as fast as possible, because doing that kind of batch processing every week simply is the most efficient way to get time done. Yes, it will take time if you begin to select or to put a 3 or 4 day lag in that process. But when you consider how much you bill a day, and you look at that amount, you could basically begin to add that amount to your cash reserves for every day that you would increase your payables. And if in fact you are in the teens or low 20s, you may want to add a little to that in order to bring you up. I think it would be important in this regard to begin to set some metrics. I want my AR department to be able to turn over bills at a certain rate. And that's going to mean we're going to have to work corrections, and we're going to have to make sure that there are clean claims going out the door faster. But I also want my payables department to begin to look at what could be paid at longer time frames and to begin to work that out, or have the CFO to begin to work out payment rates in that regard, or payment expectations with payers that would give you a little more leeway. This is a hard graph to read, and I haven't really liked it, and it doesn't work well with folks who are losing money. But my question is, how do we perform against the Treasury bill? The Treasury bill is a decent indication of how the market is changing, and how expenses for us will be changing over time. And it tells us largely what we should be hitting in order to build cash reserves for the inflation rates we may see in the future. So when the Treasury bill is low, we kind of understand that inflation may be as well. And if we compare our profit margins to it, it gives us a sense of where we fit in being able to provide for the inflationary costs a year or 2 years down the road. In this example, we're not covering that future rotation, and we haven't really done so since 2018. Another element of this is probably important to board members who may look at this, particularly business folk, and see that if you are producing in excess of a T-bill, then really all of your mission is being done for free, because they couldn't get better rates on the money had they took everything from you and simply put it in the bank. So if you are meeting that performance standard, your mission is a full gift, and it ought to be explained that way to the board and to others. One of the elements that becomes more and more important as we move ahead is the question, how much can I afford to risk? What amount of money can I put on the table when contracting with an insurance carrier for an alternative-based payment arrangement, be it bundling, be it value-based, however? It's hard to calculate that amount, but I think that the metrics I have, even though they are a little difficult to explain, kind of grip that issue. First off, I've kind of divided the costs of these metrics into 3 groupings. What's low-level risk? Things that we could put on the table without really seriously worrying about our cash abilities over the course of the year. Moderate would be a meaningful but still not risky level of cash involvement. But high-level risk would be putting the organization at true risk, and it should never be done if there are any alternatives otherwise. I could probably argue pretty effectively in the tumultuous environment in which we live that getting below a 1-to-1 current ratio is, in fact, frankly, an element of demise. It's a final indicator of that you may not have the capabilities to move ahead. In this organization, they are already well below the 2-to-1 current ratio. Because of that, there is no money that they have that they could risk at lower levels. No impacts that they could make at that point that won't in some way jeopardize them. Additionally, they don't have any money that would even leave them at a moderate level of risk. So yes, I'm showing in this metric that potentially, if they absolutely had to do it, there's about $700,000 that they could put at risk for some kind of activity around a value-based reimbursement effort or around a major strategic initiative, but it would only happen at the highest levels of risk for this company. Knowing these numbers and having them agreed beforehand with your finance committee of your board gives you really good flexibility to have arguments with them or discussions with them where everyone is operating from the same fact base. The second metric is exactly the same, but it looks at the capacity to borrow instead of the capacity to use cash. This is something that I would want to see much, much more in tune with issues around the strategic plan than in tune with issues around VBR. Contract negotiation with managed care entities in the operating performance, bottom line, profit loss area is something where cash is really king. Strategic planning or strategic initiatives are probably the only places you would want to actually begin to borrow against your future. So debt to equity ratio becomes, to me, the key. Again, I use 3 levels and began to look at those ratios as we saw them. They do not have debt to equity of 2 to 1, so that was not appropriately met. Their moderate level is about $1.5 million. Their high risk level is 5. So what I'm seeing in this, if I were to kind of just step back and evaluate this company, is an organization that has a lot of facilities and long-term assets that are now free and clear of debt, even though their cash position is relatively low. And that gives us some sense about our flexibility moving forward as we begin to talk about other issues, and as we begin to deal with what the pandemic may mean in terms of long-term strategic change. This is a good-looking graph. It talks about our line of credit. Far too many people are using a line of credit for more than an individual one-time event. At the end of each year for the last 4, this organization's line of credit has been at 0. That is absolutely key, I think, in this coming environment, to be able to deal with banks and to have banks give you the trust levels that you need from them in order to feel safe about moving ahead with your processes. This graphic is kind of interesting. I think it shows a lot, and I really would like to see people begin to use this process more. But since I began working at Open Minds, Monica and others in the organization, Ken Carr particularly, have been stressing the importance of portfolio analysis. How do we look at our service lines and determine which ones need to be trimmed back and which ones need to be allowed to grow? This analytic, I think, provides a good explanation of that. I'd like to walk through it so you can see how this organization has responded to various issues around its growth and how it is presently structured. When I laid out this graphic, I asked myself 2 or 3 questions about what is important to know about the programs of the company. The first thing I want to know is, how is it growing? Are the programs getting bigger? Are they attracting more people? Are they gaining in size? Are we adding staff to them or not? So I mapped each of the organization, each of the service lines within this organization against a graphic that moved from left to right for growth. So when you're looking at programs that are farther to your right, those are programs that are growing faster. The ones to your left are growing slower. Now you'll see that there is a 0 line both on the vertical and the horizontal axis. That 0 line for growth means that if a program is on the wrong side, the left side of that line, as Datehab is in this example, what that tells us is that program is actually shrinking in size. It actually has less. So how did I get these growth numbers? I looked back 3 years in the income statements for each of these program divisions, and I saw how that worked out and how that developed. So when compared to 3 years ago, some of these organizations have grown only a little bit and some have grown extensively. Look at the growth of the HUD project, for example, and how much it has improved. The second element I wanted to see was profitability. Compared to the amount of money we spend in this portfolio, how much does it bring in? Again, there's a 0 line up about 1/3 of the way on the chart, and organizations or dots that appear above that line, they are producing strong profitability for the expenses that are being given. In some cases, even more than 10 and 15% profitability. The big organization, the big dot you see below the line, the residential, is at about a -8, -9%. So while residential is growing, its recent endeavors have not shown that it's returning money to the organization. When we look at the third variable, which is critically important, it's how big is that program? How much money are we investing compared to the total of our company? So I looked at total expenses and I made each dot on this graph the size of this company when compared to others, the size of this program when compared to others. So this HUD project, which is out there at the high growth level and high profitability level, is also very, very small. This residential program, which is in a very positive but low growth position, is negative in terms of its profitability, is the biggest program in the organization. And in fact, when you look at this structure, the other programs that are generating profit are in fact substantially smaller. It is in fact the truth for this company that profits being generated by 5 of their 6 service lines are not sufficient to offset the large losses that occur in residential because residential gets such a huge percentage of the total. So then what can we do with this graphic? One of the exciting things I think we can do about it is divide it into fourth, as the Boston Consulting Group has done, and say organizations in that upper quadrant that are positive growth, positive profit, those are our stars, and we ought to be looking in every way possible to grow them. Why is employment and Dayhab both small? Why is Dayhab losing size when in fact their profitability is so strong? Do we have possibilities to grow those programs substantially? When we look at programs that fall both in negative growth, negative profitability, those programs are referred to in the Boston model as dogs. And in fact, those programs ought to be considered for a discontinuation and reallocation of their resources and staff to other profitable endeavors. Having this kind of portfolio analysis, I think, gives those of us who have some ability to see data visually, the capability to understand where our companies work and what should be invested in and what should not be invested in. Many people can see this from an Excel chart or an Excel grouping of numbers, but it's easier in my mind to see it graphically. One of the things I'll tell you is that my efforts to do this graph may have sounded big, but they certainly were not. Excel can produce what they call a scattergram or a bubble chart right from its selection of graphics. So you can, in just a few moments' time, have this entire process automated and updated on a monthly basis in an automated way. Frankly, I would do portfolio analysis probably quarterly, but it is not anything close to the effort involved in creating it that I might have indicated when I tried to go through the explanation. Those are the 6 elements that operate independently in my mind. As you bring it all together, sustainability is a balance. Like a good chi symbol, it's the positives and negatives. It's the coming together of things we might do to pay off debt and increase leveraging, even though it would mean a balancing negative of cash. And I've often struggled with ways to put that together in a way that makes sense. Thanks to my good friend Bob Kreider, we no longer have to do that. This graphic allows for the calculation of 5 or 6 elements that we can put together, come up with a generic number, and use that number to position ourselves on a graphic that would compare us against the bond ratings of a commercial company. The graphic is kind of a 0 to 20 scale, with people scoring 15 to 19 being in AA, AAA, or better, and people scoring lower, more concerned about structure. There's long-term sustainability for this company at 8.21. It has just moved into that range, and you can see that range example suggests that with reasonable restrictions, this company ought to be able to get into long-term borrowing with reasonable tax-exempt rates, and that would allow it to move forward. Numbers lower than 8 tend to be problematic. Pre-COVID, when I was visiting so many staff people at various organizations and getting this data, we compiled a grouping that said that the average of the industry was about 9, and that it went from about a 7.2 to about a 13 in terms of the graphic approaches. So the better people, the best in our industry, were in the A category, sustainable with significant cushions, and the folks at the lower end of our metrics fell in a category when compared to other financial payers that said short term. There's been pressure about using this graphic, and that pressure boils down to this. We're nonprofits. We should not be measured against metrics that apply to larger commercial endeavors who are simply involved in the production of money. My response is surely the last 6 months and 8 months have indicated to us that we survive by cash and by asset accumulation, just like every other company in the industry. And we ought to be concerned about our credit strength and our sustainability in exactly the same way others are. Because of that, when I look at this graphic, I can see a significant use in information that might be available by being able to map out and know better on an industry-wide basis what these numbers might mean. We can run a financial assessment product that would include all of these capabilities and give you these graphics that you could then modify to create your own individual dashboards as we move ahead in terms of performance management. What I would do at this point is pick 2 or 3 or 4 of those that matter, decide which ones you might want to recreate at the departmental level, and create a dashboard system for your own company that can be produced in a half-hour's work with very minimal effort by the finance department once the initial setup is done. I want to stop at this point and ask again, Corey, do we have questions that we want to talk about in terms of this, or ways that we might discuss how these various dashboard elements would apply to everyday problems?
Absolutely. Thanks, Ray. We have a scenario for you. The bank has unexpectedly suspended our line of credit. What do we do?
First, if we were using the dashboards that we have, we would know why. Is it because that we are over borrowed in terms of our facilities? Is it because our performance metrics are showing a significant negative curve is on the graph that's laid out? Is it because our cash metrics are incorrect? Knowing that is the first step in addressing it, making sure it never happens again, and knowing what to say to the bank when you have that meeting about this process. One of the things I'm hearing, and that may be a future problematic effort, is that with the exploration of the financial loans from the federal government, banks are taking a much more significant look at lines of credits and who they have provided that credit to. So while I would argue the mission of the company and the importance to the community, the bank is going to be interested in new metrics, and maybe those require more strength in assets or more strength in cash reserve than before. If those point to particular problems, there are great resources in the Open Minds libraries that talk to the issues of building cash resiliency, maximizing revenue, or looking at ways to refinance to get more benefit in long-term assets. But if you had those on an ongoing basis, you would know the answer to that question, and you would likely know it was coming before it did, and your finance director and you could have made an effort to go to the bank to talk about it. So this to me is one of the examples why using this dashboard system to replace the old income statement that we work from is so important in moving us ahead in a correct way. Corey, are there others?
Sounds good, Ray. Nope, we're good. Ready for the next section.
Okay. How do we implement this? How do we move it in a way that makes sense? Okay, your finance department's created a dashboard, so what? One of the things that I see so frequently in organizations that are problematic is that we really haven't organized activities by tiers of leadership. Director level people do the same thing that supervisor level people do, they just do it at a higher level. And I think that doesn't make sense, and it doesn't provide a career path for people to improve. So I'm suggesting that you look at the methodologies at this point. One, your finance department needs to do some substantial training in financial indicators and what to do about them. That kind of work is best done right now at the C-level and at the director level. Everyone at the C-level, meeting as an executive team, should be able to review the key indicators monthly and know what they mean. The monitoring should be done there, and the decision to move to address problems before they become serious should happen there. The directors should be responsible for solid quality systems and CQI on a general basis, but they also should be the ones held accountable for the financial results of their organization. The training should happen at the director level, and those directors should be responsible for that and learn how to work with the folks under them to make sure results are improved. I would say a manager ought to be involved in customer experience of care, and working through those issues. And supervisors ought to be involved in nothing more than day-to-day management and the hiring and discipline of staff. But it is at the supervisor level that most money is spent. So the supervisors need to be included with the directors in training. They need to know the impact of their decisions to give overtime or increase staffing in an organization because of some issue, or not reduce it when a particularly intensive consumer who required additional staffing is in fact moved out. Organizing it this way allows us to do efficient training of these key indicators and how we want people to use them going forward. The budgeting needs to radically change, and the radical change will not significantly impact the amount of time, though it will radically change the duties. First off, the annual budget is history. We can't afford to budget annually. We need to budget on a rolling basis. We should always be forecasting and projecting results 6 to 7 months into the future. And that means largely we need to be looking at 3 quarters of information based on forecasting. We ought to have Excel spreadsheets that allow us very quickly to extend out those activities, or in fact, if we can afford it, to have forecasting software that gives us that capability. It would be great to have a CFO walk into a CEO's office and say, 8 or 9 months from now, we're going to have a significant operating problem. We need to be addressing it now. The capabilities of addressing it without staff changes or in ways that are far less intrusive or traumatic are much better in that position. To do that, we have to give up something to give those capabilities. And what we need to be giving up is the detailed budget. No one cares how much is spent on books and subscriptions at the supervisory level. There ought to be large categories of other that we budget, not report, budget. We ought to be able to see the detail that occurred within that other category. But when we look at a particular budget, we should only be looking at key accounts. In a residential setting, for example, staffing, contract staffing, and overtime become critical. And the percentage we spend on each of those should be 75 to 80% of what we report, of what we do in terms of managerial effort, and therefore it ought to be that same percentage of what we report. The budgeting activity now is mechanical. It's the production of massive Excel spreadsheets and massive databases in financial software, and that mechanical process needs to be eliminated and streamlined so that a manager of budget can now spend most of the time in mentoring, most of the time in training staff to prevent problems from coming to the future, because as I mentioned, everything flows from operational performance. The cash of the future, the asset levels of the future, the sustainability level of the future, our risk tolerance of the future, all are based on what we do on a day-to-day level by average supervisors on the bottom line. Traditionally, we have reported only the bottom line, and I would foresee a financial report that manages from 4 or 5 indicators. A good budget with many fewer lines and many fewer cost centers in some cases should provide us information about what the bottom line is. But it should provide us that information on historically long-term programs in one regard. So are we performing in our older programs the way we expected? And it ought to be able to allow us to group up a second kind of income statement around new programs or ones that we're getting off the ground. Programs that we might want to budget on a monthly basis so that we can begin to categorize how expenses are going to hit the bottom line and how long it'll take before revenue will. That kind of information from those 2 categories gives us the capability to budget cash and to be able to watch when we think cash levels will be low and why we can address those by changing some of our expense behavior. Our strategic plan may or may not be contingent on producing profits depending on the strength of our company. But if it is, you want to be able to see the cost of those programs and the income, if any, that they are showing separate and apart from the others. So the graphic that I would see for the future budget includes cash and management and efficiencies around days in AR and cash and days in payable. It would include the traditional bottom line for traditional programs. It would include the bottom line versus budget for projects we have in place and new programs we're opening. And it would include the ability to determine if we are accurately compared to our planning in terms of the big strategic initiatives we have. Knowing these 4 things on a monthly basis will require us moving out of the detail and much more to a higher level. Will require greater automation of our finance staff and particularly potential new skill sets in our finance staff. But it will position us to be able to respond almost on a monthly basis to the kind of changes and traumas that we may foresee over the next 2-year period. I've listed many of these questions at this point. They will be there for specific responses. Let me just say that in terms of an Open Minds project, we're capable of doing this and helping you establish your benchmarks and build your dashboard product over the course of a very short period of time, and much of that can move ahead as we see that. I've added some resources I think you might want to reach in terms of discussion, but in general, I think that portrays ways that finance may change in the future, and we can begin to use a new dashboard to talk to our staff about what's important and why. Corey, are there other questions at this point?
Thanks, Ray, and I think that takes care of it for today. I want to thank you, everybody, for joining us for today's web forum, and I want to remind everyone that the slides and recording for this web forum will be available tomorrow on the Open Minds website. and that we will be back next Thursday at 1 p.m. Eastern for the web forum Measuring and Improving Consumer Experience, Consumer Engagement, and Consumer Performance, a Best Practice Approach. You can sign up for that under www.openminds.com. It's listed as webinars under the events tab. And with that, thank you again, Ray. Take care.
Bye, everyone.